we're in a very different position than we were in March, April, May, June of 2020.
Markets have to be prepared for a rate hike at every meeting.
There's a real danger for a Russian invasion.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Klaas Knot says the ECB could raise rates as soon as October. Yields surge as bumper jobs numbers fuel hike expectations. Bolstering the border while the U.S. and France discuss how to strengthen Europe's eastern flank. Macron heads to Moscow to meet with Putin. And the EU pushes to lead on tech standards. This hour, we speak exclusively to the EU Commissioner Thierry Breton. Send in your questions on IB Plus TV Go. Also, red hot oil, Europe's dependency on Russian gas, and energy poverty in the UK. Later this hour, we have much more in our half-an-hour special, the price of power. But first thing is first, so let's check on the markets because we're seeing a repricing and a widening of spreads between German yields and much of the periphery. Now, this is on the back of European stocks actually gaining some 0.4%. Remember, if you look at China, they had a week-long holiday. They're back and they're playing catch-up. So a lot of the technology stocks are actually supported in China. That's filtering through to Europe. We also had some expectations or earnings that were better than expected, but it's all playing out in this space. The Italian 10-year yield, you can see at 1.816. And there's the biggest differential in at least 12 months with, for example, the German bond. The widening gap just keeps on widening. It certainly did in the last hour or so. The focus is what we heard on the ECB, and it came in the Q&A with Christine Lagarde. Definitely a lot of market participants thinking now the hawks have been taking place at the European Central Bank. This would have an impact, of course, on when they start hiking. But then we heard from Klaas Knot saying, look, this could come as early as October. The market is actually pricing in a 25 basis points hike in September. And this brings me nicely to the map where you see support for the DAX gaining 0.4%, the FTSE on the CAC 40. But Italy, probably the one that's most sensitive to some of these yields, actually down some 0.3%. So the ECB Governing Council member Klaas Knot says he expects an interest rate increase as early as the fourth quarter. That comes after the Euro area central bank made a hawkish pivot last week with President Christine Lagarde now no longer excluding a hike this year. Well, we're joined by Jane Foley, head of FX strategy in Rabobank, and Bloomberg's Christina Aquino. First of all, thank you both for joining us. But Jane, what did you make of that hawkish pivot? Because it's unclear whether it was coordinated, so with the rubber stamp approval of the Governing Council, or whether it was a slip up in the Q&A.
Well, we're going to find out, and we'll find out really over the next few days. And I think Lagarde may be scheduled to speak this afternoon too. And I think this is the period when the dust is settling, when she is able to, her and perhaps Lane and some other members of the Governing Council will be able to give us more direction. What did she mean? Yes, we've had that hawkish pivot. I think we all understand that. But did she really mean to imply, as markets have interpreted, that rates could be going up by 40 or 50 basis points by the end of the year? Perhaps that's too much. So I think this is going to be a really important few days, a couple of weeks, whilst she really does give us a little bit more clarity into what she actually means.
Yeah, and Christine, this, of course, is something that we've been talking about quite a lot, and it's my morning must-read comes from Eric Nielsen that lays out the concern. Is that, we heard from Isabel Schnabel, we heard actually from Philip Lane as well, and they didn't see much movement in terms of the hawks taking place, and suddenly we have a repricing of markets.
Absolutely, Francine. And so it really will be a communication challenge now for the ECB Governing Council. Now that they've seen that initial reaction to the possibility of an ECB rate hike this year, they can kind of finesse that message as we hear from Lagarde and other Governing Council speakers this week. I think it really will be now all about the nuance in terms of the timing and pace. Of course, this is something that's very, very much on the radar for markets and something that they will definitely be watching these speeches for and seeing any detail from there as to any indication of how fast the ECB could go and, when they're really going to fire that first shot in terms of rate hikes.
Jane, let me bring you to my morning must-read, which is Eric Nielsen actually laying out some of the concerns he has when it comes to ECB policy and that pivot, a lot more hawkish. Overall, do you worry about the Bank of England and the Fed being behind the curve more than you do about the ECB actually, delivering a confusing message like Eric Nielsen supposes?
I think what we've got to understand here are the differences between, these three economies, and in the Eurozone, I think it's fair to say, and I think Lagarde, has always made this clear, that in the Eurozone there still isn't that wage inflation threat. So she isn't behind the curve, so to speak, in the way that maybe you could accuse that the Fed of being. They don't have those second order risks through, but she is mindful, as most economists are, that the longer inflation remains elevated, the longer that, or the bigger the risk that it feeds into second order effects, feeds into inflation expectations. That can have an impact on, say, wage negotiations, etc. So she wants to, kill it now, kill those the risk of those second order effects. But if we go into the US, look at that wage inflation number that we saw on the payrolls last week. That's a different story. The Fed, I think, you can accuse of potentially being behind the curve. And I think the Guard really needs to explain those differences. And I think that's perhaps what we're going to hear more of in the coming weeks.
Yeah, and we can see our Valerie, of course, our market watcher, really saying, look at the Greek 10-year now 21 basis points higher. Christine, I know these are big moves, but put into context, I mean, they could come down if the ECB were to say something like they're here to close spread. So are we going to see, dip buying in bonds?
Yeah, that's the big question, Francine, for sure, because it's really not just the ECB, that could keep those bonds in control and compress. There's also a bevy of investors that have been long suffering through negative European yields, or really, really low European yields, are suddenly coming to the realization that that era is really about to come to an end, and perhaps increase the attraction of European bonds. We know, for instance, that Japanese buyers, especially those pension funds, life insurance funds, are really big fans of the European bond market, but they just haven't been able to really buy into this market for the longest time because of the really low rates here. But now that we're seeing signs of this era coming to an end, potentially you could see that inflow of foreign demand now that the yields are yielding a little bit more above zero in the case of Germany and quite a bit more in the case of the periphery.
Jane, if you put this into context with us, I know it feels monumental and will have all sorts of repercussions for the rest of the yield curve, certainly in Europe. But then you look at the Fed and how they've messaged forward. I mean, we could see this global bond route deepening also impacting a lot of the FX.
Oh, completely. And, we've seen that to a large degree already. I mean, we look at, euro dollar. I had been anticipating that it might be the second half of the year when we begin to see this turn in the euro, where we begin to see the market really focused on the possibility of tightening that for the ECB. But, we've got this much sooner than I had anticipated. We've got this turn. And it's quite interesting last week that we had, the RBA also have this hawkish tilt as well, indicating that there could be an interest rate hike after all this year, despite the guidance that we've been having. We might have the Bank later in the week. Perhaps that's going to be the next central bank to announce this hawkish tilt. So we are having this movement coming through, quite suddenly, and of course it comes on the heels of the Fed, through November, December, early January. It's amazing to see that fast pace of acceleration of the hawkish rhetoric, really quite startling. So we are seeing this move, and it is feeding through into foreign exchange already. And of course it really is. Will the euro continue to go higher now, or will the Guard, try and make a little bit more sense of this and say, yes, we made a hawkish tilt, but that's all it is for now. So it's going to be interesting to see what happens there.
Yeah, and we see those yield spreads widening. Thank you so much, Christina Kino, our markets editor, and Jane Foley, head of FX strategy at Rabobank. Both stay with us. Now, this is a huge repricing, actually quite monumental, and it could continue further until we hear from more ECB Governing Council members. Just a reminder, the market expecting a 25 basis point hike from the ECB as soon as September. But actually, we had comments from Klaas Knot over the weekend, the hawk of the hawks within the Governing Council, and he was saying this would probably happen in the fourth quarter, but then he's expecting another one early 2023. Now, coming up, U.S. job numbers surging despite record COVID infections, adding more pressure on the Fed. More on that next. This is Bloomberg.
was a very good report, a very solid report. And I think underlying what it's telling us is that we're in a very different position than we were in March, April, May, June of 2020. We're seeing people in economies, in workplaces, and workers and employers really learning to live with the pandemic and adjust. So we are in a different place there.
Well, that was U.S. Secretary of Labor Marty Walsh speaking to Bloomberg after the release of the latest U.S. jobs report. We're back with Jane Foley, head of FX strategy at Rabobank. Jane, we spent a good amount of time talking about the ECB, but it does seem that the world's most important policymakers as a whole are taking turns to emphasize exactly how the market expectations or the market's environment is in the process of this momentous shift because of a hawkish tilt. So who's getting it right, and what do you think is being mispriced at the moment?
Well, I think I mean, we can talk about mispricing or we can talk about just adjustment, because I think what we've seen is just a very rapid adjustment coming through from the rhetoric from central banks in terms of, what's happening in the economy. And I think if we go back perhaps even 6 months, we were still using the term transitory. We were still anticipating that inflation was going to go away because we were saying, well, this is all to do with supply side. But I think what was ignored was the real big shift in demand. And perhaps that was related to this huge amount of fiscal spending that we've had from various governments. The US certainly included in that. And I think we've had this permanence perhaps in inflation at least through for a far longer period than most of us had anticipated a year ago. So that's what we're adjusting to. The central banks are adjusting to that. You asked the question previously, are the central banks behind the curve? Perhaps the Fed is, but certainly it's going to come through. And I think the next question will be, after all of these hiking take place, particularly in the US, can we avoid recession? Will there be a hard landing? Right. Can they get it right? Can they get the amount of tightening just right to avoid that hard landing?
So, Jane, let's go back, because we are seeing a meltdown, certainly in some of the Italian bonds. Let's go back to those spreads and bring them up on screen. But I guess the key question then for investors overall, no matter where you are in the world, is how much of the tidal wave of tightening should be priced into assets immediately versus gradually. So do you think the repricing is too aggressive right now?
Again, that question is going to become a lot clearer perhaps in 3 months' time as we begin to look back. I think Lagarde's real aim in the next couple of weeks will be to try and send out a message that, yes, they've tilted, but they're not going to be hiking particularly aggressively. They don't perhaps need to in the EU yet, because we don't have much of that second-order effects. They just want to stop those second-order effects appearing. Different story in the US. We already have the second-order effects. That's why they're going up very aggressively. But if you look at some of those yield curves, for instance, if you look at the yield curve in the US or the yield curve in the gilt market in the UK, you're seeing quite a lot of flattening. And that is a message I don't think we should ignore, that we can ignore. And that is something that suggests, well, look, there is a danger here of these central banks tightening so much to get this message through about inflation that they could overdo it. And we could actually, by the end of the year, really be ratcheting up the risk of recession. And I think that's, the next part of this story.
Yeah, and I guess into this vulnerable bond market comes also this US CPI print that's forecast to rise again. Jane, what does this all mean for dollar? And maybe the differential there to play is renminbi dollar.
Well, if we look at renminbi, then we know that we're looking at a Chinese economy that's slowing. We're talking about increased accommodation. And naturally, if you've got a central bank wanting to do more accommodation, you generally see the currency slip. And I think that's what's going to happen. I think the more interesting story really is the dollar. And also, I think we've got to think about the dollar in the context of an economy, of a central bank that's tightening, but also the dollar is a safe haven. And this, I think, complicates the story here, because we have, of course, these potential safe haven flows coming through from what's going on in Ukraine, Russia, what could happen at that border, but also, something that perhaps it's been a little bit more ignored in Europe, and that is what's going on in terms of China. We do have Blinken going over to Australia, Hawaii, etc. This week. There's going to be a meeting between some of the Quad countries, India, Japan, etc. And that's related to China. So there is the potential here that we could see the dollar as a safe haven coming closer to the fore, and I think that's something which could help support the dollar through this year as well.
Thank you so much, Jane, as always, for joining us. Jane Foley, their head of FX strategy at Rabobank. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Canada's capital has declared a state of emergency as police struggle to contain ongoing protests against vaccine mandates. Ottawa's Mayor Jim Watson says the demonstrations pose a threat to the safety of residents. The protest started in reaction to Canadian and US laws requiring truckers crossing the border to be fully vaccinated. Hundreds of truckers continue to occupy Ottawa's downtown area. Now, the White House says President Joe Biden and his French counterpart Emmanuel Macron have discussed their response to Russia's military buildup on the Ukrainian border. The two talked about moves to strengthen NATO's eastern flank and efforts to deter Russia from invading. That comes ahead of Macron's trip to Moscow and Kiev that's due this week. Russia has repeatedly denied it does plan to attack Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, the EU unveils a new strategy that seeks to counter China's influence over global tech standards. We speak exclusively to the EU's Internal Markets Commissioner. He's Thierry Breton. He's up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the European Union is seeking to boost its role in setting a standard for key digital and green technology. That's amid concerns that China and some corporations are wielding excessive influence. Well, the Commission's plan is to leverage cooperation with the U.S. and other like-minded nations. Well, let's head over to Bloomberg's Maria Tadeo, who's in Brussels with a guest.
Yes, and Francine, I'm joined by the man himself, Commissioner Thierry Breton. Thank you so much for joining us. It's always good to see you. And, you know, this CHIPS Act that you're presenting, you say this is going to be huge. What does huge mean in actual terms? How much money?
That's a lot of money, yes. That's a lot of money that we need to put on the table to support our company. Because in Europe, we are the center of the world in terms of R&D for semiconductors. But it's true also that we don't manufacture enough. Most of our semiconductors, and you know, everybody knows what you do with semiconductors. You use it in your smartphone, in your car, in your fridge, but also for health, but also for computing, everywhere. But this is now mostly manufactured in Asia. And when I say Asia, it's around Taiwan.
China.
No, it's more Taiwan, Korea, South Korea, Japan, a little bit China too. But Taiwan, yes, more than 50% is coming from Taiwan, and we know that it could be a little bit tricky over there. So we have decided now to increase drastically, to multiply by four, the production of semiconductor here in Europe within the next 10 years, but also to make sure that we'll be able to bring all the money for R&D. We'll put on the table 12 billion euros just for R&D, and in addition, 30 billion just to support mega fabs, and also a significant amount to support startups. Altogether, you know, I said that it will be probably around or over $50 billion. Yes, this will be the case.
So that will be the case. So help me understand, you know, we say 50. I mean, this number looks huge from the outside. I mean, you could argue it's comparable to what the U.S. is doing. Is this going to be public money? Is this going to be private? Are you tapping into European enterprise? How do you structure this?
When I say around $50 billion, it's just, again, supporting. So it's grants and it's public. And in addition, of course, we will have a lot of private money. So this is pretty huge what we are doing here in Europe.
And you say it's pretty huge, but I wonder, is this because perhaps you're concerned about China? This is how it's, you know, often gets presented. I mean, this is not a secret that China comes into Europe, they buy everything up, they take it away, and then we have nothing left. Is that the reason why you're doing it?
That's a good point, because we need, in addition to this, we need also to secure all the supply chain. Not only we will make the most advanced semiconductors in Europe, and I said for the specialist, below 2 nanometers, which is extremely complex semiconductors we will design and manufacture here in Europe, But also we need to make sure that all the line will be secured, whatever could happen. And that's why, again, of course, we will work with our like-minded partners. But if you have a crisis, and we learn this the hard way, especially for the vaccines, even your best partners, like US,
becomes a rival.
I mean, not rival, but they have to serve their interest before the others. This is why in the US you have a DPA, you have a special, let's say, act to protect in case of crisis. We do the same thing in Europe, of course, to make sure that if there is a crisis, we'll be able to secure our supply chains.
And do you worry perhaps that countries, rivals, perhaps strategic like China, but also friends like the United States may say, Europe is becoming a little bit protective over there?
Not at all, because we are doing exactly what the US are doing, and we are discussing a lot with our US friends. But of course, we are not naive, and we are a power. So we need to behave, just not being naive, and being a power. We know what we can bring for us and for others. By the way, we will export a lot of semiconductors also for other non-EU markets and for our friends. But we need to make sure that we can secure the supply if there is a crisis. But we are not at all protectionist. We will not do more than what is the US doing in case of a crisis with the DPA.
Well, Commissioner Breton, thank you so much. It's always nice to see you. Thanks for being on Bloomberg TV, as always. Francine?
Thank you so much, Marianne. Thank you so much to the Commissioner. Coming up, but we have the price of power, half an hour to talk about the red hot rally. This is Bloomberg. Well, good morning, everyone, and welcome to the Bloomberg Price of Power special, looking at the global energy crisis. I'm Francine Lacqua here in London. Now, taking a pause, oil fluctuates after 7 weekly gains. Saudi Arabia boosts prices, signaling confidence in demand. Europe's Russian gas problem will no signs of de-escalation between Moscow and the West over Ukraine, the continent's energy dependency in the spotlight. And UK energy watchdog Ofgem amends its price cap regime, while British households could face a worst squeeze ever. This hour, we speak with the chief executive of energy provider Ecotricity. Now, Brent crude fluctuating in Asia, trading today following a run of 7 weekly gains that pushed oil to the highest level since 2014. So here to take us through what's up with oil is Bloomberg's Danny Berger. Danny, first of all, how tight is the oil market right now?
Francine, it's so tight that currently we are in super backwardation. Not only is it industry speak, but just frankly, it's a very cool phrase. Essentially, this means that the curve is very steeply downward slope, so traders are happy to pay up for contracts now versus into the future. The fundamentals do support this very, very tight picture. You have extreme cold in the Permian Basin, which means that that's curtailing U.S. output. There are questions as to whether OPEC Plus can hit its output targets, and of course, geopolitical concerns that continue to add risk to the upside.
So I guess, the million-dollar question is how high do traders think it can go?
There are very high bets at the moment. We've heard a lot from Wall Street saying a triple-digit oil. $100 really isn't that much of a stretch at the moment, considering we have Brent in the low 90s. Francisco Blanch over at Bank of America continuing to say 120 we could see on oil. We heard JP Morgan last week join in on that call if we have increased geopolitical tensions. And at the moment, option traders have gone wild for really steeply priced oil options. The amount of $100 calls right now is equivalent to 112 million barrels of oil, and options for 150 and 200 striked calls have quadrupled since the start of the fourth quarter. So these are some really big bets in the options market.
Huge bets. Danny, thank you so much for Danny Berger there with a look at the charts, looking at some of the things that we should worry about. Now, we're joined by Jeff Currie, Global Head of Commodities at Goldman Sachs, and Fiona Boll, Head of Commodities and Real Assets at S&P Dow Jones Indices. Thank you both for joining us. Jeff, I know you have a $100 call. When can we reach that point?
Right now, the upside risk in this market is exceptionally high. One of the reasons why, is alluded to, the markets are incredibly tight from a physical perspective. Whether you see it on the refining margins or in crude oil itself, the entire complex is extraordinarily tight, reflected in that super backwardation. Obviously, what it means is that this market is incredibly vulnerable to any type of supply or demand disruption, very much like what we saw in European gas and power, let's say late last year. So oil has now teed itself up, to look very similar to what European gas and power looks like. That was what we highlighted this risk back in October of last year. We're at that point right now. And so the question is, can you come up with any supply or reduction in demand as you move into the spring to be able to ease the situation?
All right, let's get to Fiona, and then I want a bit of a timeline from you, Jeff, about when we could see this happening. Fiona, what are you expecting in terms of prices by year end and from now and then?
I think, as Jeff said, we're really in a very tight situation. We talk about being at tank bottoms, so we just don't have that leverage if something goes wrong. So if we see, continuing situation, I would expect, prices to remain, around where they are, but there is definitely the risk to the upside, and it's not insignificant.
So, Jeff, talk me about, I don't know whether we can talk about sequencing in the price of oil, but once it touches 100, are you expecting it in the next couple of months? And then what happens? Is it a trend of higher, or could it readjust?
Well, it's difficult to say, in terms of what kind of, demand is far stronger than I think what anybody thought, because the Omicron impact is not as significant as even we embedded in our models. And then we look at the supply situation, the continued underinvestment in supply leaves this market incredibly vulnerable. Now, the question is, what is the upside limit here? One thing I like to keep in mind is if we think about the amount of liquidity in the system today, and we look at oil versus liquidity, the run-up we see in Canada, you don't even see it on a picture. Because the liquidity so overwhelms the movement in oil and commodity prices. And a lot of people go, okay, look at oil as a share of GDP. Let's think about it in terms of liquidity, because that really determines on the ability of the system to be able to deal with these price increases, particularly when some of that liquidity is going to the lower income groups.
So, Fiona, this is the chart that we were talking about, and it shows exactly what Jeff is mentioning, right? Which is Brent showing this unusually strong backwardation. And actually, if you bring it back, there are only 11 trading days since 2008 with an equal or stronger, second to third time spread. So, how tight is this? Is there, have we seen any signs of demand destruction yet as prices soar, actually?
Well, if we look at the European power market, we've certainly started to see, signs of demand destruction. The same here in the UK, with some falling off of sort of manufacturing demand for things like natural gas. And I would expect that we may be getting close to that point in the oil market where we do see some demand destruction. But for now, again, as Jeff said, demand's incredibly tight. I've been amazed, particularly in the US, with the distillate demand, really illustrating just how strong the manufacturing and the transport sectors are.
Jeff, the call option activity is really exploding. What does it tell us?
The expectations of the market is substantially higher from here. Because I think what that's pricing is the asymmetry in the risk profile, because when your inventories are incredibly low, at tank bottoms, you expose the market to these upside price spikes. And that's what the option market is trying to price right now. But I actually want to emphasize here, the participation from the investor community is extraordinarily low. The liquidity is a fraction of what it was going back, let's say a year and a half ago. The investors have abandoned the space on commodities, equities, anything commodity related or old economy, which just creates more upside risk here at this point.
But when are you, Jeff, expecting some kind of, significant demand destruction?
It's clearly at higher levels from here. We think you get into that 105 range. Places like India, Indonesia, Brazil start to run into problems. We'll see what happens to the dollar in that environment, because if you get a weakening dollar, it buffers them and then the price can go much higher. But that's using historical relationships. And those historical relationships may not be appropriate here with the type of liquidity that's in the system.
Fiona, are we looking at a 2008 kind of shock? I know it's difficult to put, the price of oil, or certainly the oil markets, in parallel with the recession that we saw. But what parallels would you draw, if any?
I like to say,
I think it's
2000. Oh, sorry.
Let's do Fiona first, and then Jeff, you can come in.
Okay.
No worries. I think it's difficult to draw a parallel to what we're seeing now. We really are seeing very strong demand, but at the same time, we're going through this so-called energy transition, and that was not the case in 2008. So, we're talking about massive underinvestment in these so-called, bad sources of energy, of which oil is at the top of the list, and so the situation is quite different than what we saw in 2008.
Jeff?
Now, 2008 was a financial crisis. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it. And it's, the backwardation in this market is an indication of just how different this market structure is from 2008. 2008, the curve was going up by the back end, dragging it up. It was in contango at some points in time, which tells you it was paper financial buying on the back end as opposed to outright shortages. This curve is it's super backwardated, and many of these commodities are super backwardated, which is textbook shortages. In fact, when Keynes created the idea of backwardation in the 1930s, this was what he had in mind, and we have not seen such types of backwardation. I've been doing this 30 years, and I've never seen markets like this. This is textbook shortages.
Yeah, and actually, let's bring back, I like your hand movements, Jeff, but I'm going to help you out and actually put that chart up, looking at the backwardation that we've seen. I think we're looking at Brent, and again, it's only 11 trading days since 2008 with equal or stronger second to third time spreads. There you go. You see it there. We'll have plenty more, of course, with Fiona and Jeff. Fiona Boll from S&P Dow Jones Indices and Jeff Currie from Goldman Sachs. Now, coming up, the West is in dialogue with Moscow, while at the same time depending on Russian energy. We'll discuss that story next. This is Bloomberg. We're also looking at the global bond rout, definitely deepening as we have those job surges in the U.S. They're boosting rate hike bets, not only with the Fed, but also the ECB now coming into play. If you look at the spreads in Europe, they're widening. There's definitely a melt up with the Italian 10-year yield now at 1.841. This is Bloomberg. Economics, finance, politics. This is Bloomberg Price of Power, looking at the global energy crisis. I'm Francine Lacqua here in London. Now we're back with Jeff Currie from Goldman Sachs and Fiona Boll from S&P Dow Jones Indices, both still with us. Jeff, when you look at the concerns, of course, over Russia and Ukraine, with Russia saying, look, they're not ready to invade, but also the amassment of troops at the border, what does that do to gas prices going forward? And is it, is something ugly happening on the geopolitics already priced in? Or could we see real disruption?
Well, I think the probability of a disruption is still very, very, very low. We don't have data to go back this far, but I've been told the only time we've ever seen Russia stop supplies to Western Europe was the day Hitler invaded Russia, and was it 30, whatever. We don't know if that's true, but I tend to think, again, the game theory of that is probably true. It's so. It's mutually assured destruction between Western Europe and Russia. There's no, it's not in the interest of Europe to cut, consumption of it, not interest of Russia to cut the supplies. The market prices in the potential for, let's say an accident, the risk of an accident in Ukraine or something like that could be very devastating. But in terms of thinking about the implications of an outright stoppage, I go back to the idea, your game theory is mutually assured destruction.
Fiona, what exactly is priced in on the markets right now?
I think the market is pricing some risk, but it's certainly not pricing the worst case scenario. There is little incentive for it to get to that, and the market seems to be reflecting that sentiment.
Fiona, talk to me a little bit about some of the renewables. So first of all, on the subject of energy dependency, right? This month we spoke to the Ørsted chief executive, Mads Nipper, and he told us that solar and wind could offer a solution to the price swings we're currently seeing. So first of all, let's listen to the chief executive.
The fact that prices have spiked means that we need to accelerate the build out of renewable energy and therefore be much less dependent on gas imports from different parts of the world. Both wind and solar build out combined, hopefully also with more storage, is the solution to these price swings, not the reason for it.
Fiona, what kind of price or what kind of temperament do we need or temperance from renewables do we need to make sure that the energy prices stay on track?
Look, I don't think it's an issue of wanting the energy transition. The trick's in the title. It's a transition. It's going to take time. So I'm not sure even a significant spike in the price of traditional energy sources is going to be able to accelerate the build out of those alternative sources quickly enough. I think we're in for a pretty wild ride over the next few years as we try and move as quickly as we can to adopting more of those renewable sources into our global energy plans.
Jeff, I want to bring everyone's attention to a wonderful column piece that our Javier Blas from Bloomberg Opinion has put in place. And basically he says, look, the world needs to give up its addiction to fossil fuels. That's what a lot of governments want to do. But really, as the UK is discovering, it's not going to be easy and it's not going to be cheap. Do markets forget that, Jeff?
Yes, completely. I've forgotten it, and I think that governments need to do this in a very global, uniform fashion because one thing about climate change, local solutions don't solve the global problem. We need a global carbon tax such that everybody's facing a similar type of tax. And as you want to reduce the overall consumption, you turn up that tax or that carbon price to achieve that. The problem with ESG, it's a blunt tool. It's cutting supply overall across all hydrocarbons at a rate that is too quick, and it creates the equivalent of a carbon tax where you don't collect the tax revenue and the price is substantially higher than what you would get under a carbon price or a carbon tax. So right now, we're not in an environment in which we're starting to create a organized way to reduce that dependency on hydrocarbons.
So, Jeff, we have some of the calls on where you're expecting them to go. When do you expect the price of oil, but also gas, to ease off a little bit? I know over the weekend we also had this big refinery outage in Texas, and the U.S. products market is already tight.
Well, in terms of thinking about the product markets, it's reflective of that strong demand, better than expected demand due to the fact that Omicron wasn't as severe as it ought. You also have outages of refineries. We have high carbon prices in Europe, making it more costly for refineries to operate. So you're exacerbating an already extremely tight product market, again, emphasizing just creating more upside risk in product prices as well as oil prices.
But Fiona, I mean, the role of OPEC, they said they will try and add more supplies, but actually so far they've failed.
They sure have. My colleagues at S&P Global Platts think they're only going to do around an additional 200,000 barrels a month. So that's half of what they've said they've done. It's really only Saudi, the UAE, the usual suspects that have any spare capacity. And we shouldn't forget that these are country-specific quotas that they're working under now. So even if Saudi was going to increase production, it would be going against the so-called rules of OPEC+.
All right, and let's also remind, of course, everyone that we talk about it from a trading point of view, but if you look at the U.S. pump prices, they've been the highest since 2014, and we have a great chart illustrating that as well. Thank you both for joining us for a spirited conversation. Fiona Boll, Head of Commodities and Real Assets at S&P Dow Jones Indices, and Jeff Currie, Global Head of Commodities at Goldman Sachs. Thank you as ever. Now, coming up, we stick with energy as we focus on a pioneering UK company that seeks to alleviate the country's growing gas prices from sustainable and green sources. That story up next. This is Bloomberg. This is Bloomberg Price of Power. I'm Francine Lacqua here in London. Now, Dale Vince left school at 15 to join the New Age traveller community. By 1995, he'd founded the British renewable energy company Ecotricity, which now supplies around 200,000 customers. In recent months, he's been calling for the government to impose a windfall tax on North Sea oil producers and for a public inquiry into the UK's energy market. Well, we're now delighted to be joined by Dale Vince with the very latest. So, Dale, thank you so much for joining us. If you look at what some of the governments have been put in place, some of the policies certainly that the Chancellor wants and the Prime Minister want, what do you think about the price cap and what the Chancellor wants in terms of bills?
I think the price cap has fundamentally caused the pain that we've felt in Britain, which is beyond the pain felt anywhere else in the world, I think, from the spiking global prices. Because by holding retail prices down, allowing wholesale prices to rise well above them, the government have forced companies to trade at a loss, and that has bankrupted 30 players in our energy market, nearly half the entire sector. So that's a fundamental problem. I think what the government announced last week, lending customers £200 to help them pay, which by then will be a £1,000 bill rise, is pathetic, actually. If energy prices are too high, government should actually do something about it. And of course, a windfall tax. We're seeing about 20 billion excess profits made in the North Sea. That would make great sense. It'd be very ethical to do that. Sorry, it was a long one.
So I guess, Dale, I mean, first of all, how do you think it will be easy for energy companies to roll out the discounts? And if you're asking for, a tax on something else, maybe it puts more pressure on the economy. So first about the rollouts and the tax incentives, how easy is it to do that?
It looks really complicated to me. It looks like it adds another massive layer of complexity to energy bills. They're already complex. It kicks in October. I don't actually know if the £200 is in one lump or if it's spread over 12 months, but we know that 12 months later, it has to be repaid at the rate of £40 a year or something, and again, probably spread over 12 monthly payments. So it looks very complicated and drawn out. And the 20 billion windfall tax is not going to be harmful to our economy because these guys in the North Sea sector weren't expecting to make this money. They don't need this money, and it won't harm investment in the North Sea.
So why do you think the government's not doing that?
I think the government are very close to the oil and gas industry. We subsidize it already. It was proved in court in Britain about 2 weeks ago that we put more money into the North Sea by way of subsidy than we take out by way of tax. So fossil fuels are a loss-leading product for Britain in the North Sea, and it doesn't make any sense. We should be spending that money on renewable energy. As a previous guy said, the Orsted Kai, that's the way to solve the problem.
Yeah, I mean, we also have this great, and at times, Dale, I guess it's not as easy as people would want to. Our Javier Blas also wrote this beautiful piece saying, look, the world definitely needs to give up its addiction to fossil fuel, but as the UK is discovering, it's not easy and it's not cheap. Give me a sense of when you look at the discounts that you think are extremely complicated to roll out. Are you worried about the timeline that actually they get, you get the relief in October when we could see another increase in prices?
We will see another increase in October. I think that's pretty certain. That's why I referred to the £1,000 total bill rise by October. I think renewable energy, is often described as being not cheap, but it's the cheapest form of new energy that we can build, and we have to build new energy. And if you look at this crisis, this fossil fuel crisis this winter, this cost our country £20 billion at least. The bankruptcies in our energy sector have cost us another £4 billion. All of that money is wasted. We could have spent that money on infrastructure, renewable energy infrastructure, to help us reduce our dependence on global markets.
Yeah. All right. Thank you so much, Dale Vince there, of course, for all the green energy promises and plans. Our Javier Blas also argues that the current energy transition is just in its infancy. Dale Vince, he's chief executive of Ecotricity. Now, that's it for today's Bloomberg Price of Power special. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kailey Leinz in New York. Anna Edwards is here in London. Huge yield moves, certainly when it comes to BTPs and bonds. This is Bloomberg.
we're in a very different position than we were in March, April, May, June of 2020.
We did what we could on the fiscal side to make sure that we had a swift recovery. It is up to the Federal Reserve to use their toolbox to ensure price stability.
The Fed wants to tighten financial conditions, but it doesn't want to crash confidence and over-tighten.
Markets have to be prepared for a rate hike at every meeting.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Monday, February 7th. Our top stories today. The global bond rout spreads. Strong U.S. jobs data and hawkish ECB comments stoke expectations that central banks around the world will be aggressive when it comes to raising interest rates. President Biden and France's Emmanuel Macron discussed the Russian military buildup near Ukraine a day before Macron heads to Moscow. Meanwhile, Germany's Chancellor Olaf Scholz makes his first visit to the White House since taking office. And shares of Peloton are soaring today. There are reports the fitness company is exploring takeover options. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards, live in London with Matt Miller and Kailey Leinz over in New York. And Kailey, another week of focus, it seems, on the higher rate environment.
Yeah, absolutely true all across the world, Anna, and that definitely was true in Asia overnight when it came to some of the selling pressure we saw in the bond market. As far as how the session went down in the equity market, though, mostly it was lower. The MSCI Asia Pacific Index off a few tenths of 1%, just about a tenth of 1% or so. One exception within that, though, was China, which opened back up after the Lunar New Year holiday, the best post-holiday open, in fact, going back to 2019 with that CSI 300 up about 1.5%, likely playing a little bit of catch-up to the rally we saw in other global benchmarks last week while that market was closed. Hong Kong was lower, though, and that was really a drag led by technology, and that technology drag was led by Alibaba. Those shares in Hong Kong down 4.5%. It filed with the SEC here in the U.S. on Friday to register 1 billion ADRs that hadn't been registered before, and a Citi analyst saying that may indicate that SoftBank may be getting ready to sell part of its Alibaba stake. So that dragged those shares lower today. And speaking of selling things, as I said, you did see that selling pressure in Asia Pacific bonds overnight, including in Australia. The 5-year yield there up 7 basis points to 1.71%. That is the highest going all the way back to March of 2019. So about 3 years, Matt.
All right, so we'll be watching very closely the rates picture. The question is, does that, if anything, say something about what's going to happen in equities? S&P futures right now down. Just about a half hour ago they were up, but not big movements. And we didn't have a big close on Friday either. You had the S&P up about 0.5%. The Dow was down just about 0.1%. So not a lot of action in equities. It's all about rates. You can see the 10-year yield here up 1 to 190.86 right now. Investors are still selling off bonds just a little bit. Not a lot of movement there, but the levels are what you want to watch, and especially the levels in spreads wherever you look. NYMEX crude is coming down 1.25%, but still well over $90 a barrel. So 91.13 is a level there as the geopolitical situation fails to calm down. And then Bitcoin up 2% today, 42,511. So does this say anything about where we go in equities? It has been a risk indicator, but doesn't look like it today, Anna.
Yeah, absolutely. The equity story is linked, of course, to the bond story and those Tina narratives. There is no alternative. One of the key reasons for holding stocks. How does that fare then, Matt, as we go through this higher rates environment? Is that something that's weighing on European stocks in some places, or is this very much around the divergence we're now seeing across Europe and fear around debt levels in some southern parts of Europe? So we are seeing some northern parts of Europe. The equity map is looking fairly green still. The brightest red, though, coming through in southern Europe. It's not 2011, but it does seem as if we are going to be talking about some of those similar themes around spread widening. I'll show you that in a bit more detail. I've got the Italian BTP yield over the German Bund, and this shows some widening. This has been widening this morning, continues to do so. 163, the highest since the early days of the pandemic we're talking about here. London, meanwhile, cushioned by what we're seeing in basic resource stocks. That's the sector moving to the upside in today's session. Reckitt Pengisa Group, another stock in focus in London. That one moves a little bit higher. A Bloomberg scoop there. They could be interested in selling their infant nutrition nutrition business. It had been really key to that consumer goods company. And Faurecia, this is a company that bought one of its German rivals, all about auto parts and pivoting, really restructuring and moving towards electric vehicles. How well can they do that? They put out some new targets today that have gone down well with the market. That stock up by 2.7%, Kailey.
All right, a few stocks to watch in this Monday session, and there's a lot else to watch on this Monday and through the week ahead. Later today, U.S. President Joe Biden will be hosting German Chancellor Olaf Scholz to discuss the situation in Ukraine. Those two will be meeting at the White House this afternoon here in the U.S. Meanwhile, French President Emmanuel Macron plans to visit Russia and Ukraine on Tuesday. Also on Tuesday, SoftBank reports its earnings. Founder Masayoshi Son will face investors with a number of major questions. And then the big data point of the week here in the U.S., CPI on Thursday. Inflation still expected potentially to have a 7 handle. Finally, we'll get more European bank earnings with Credit Suisse, BNP Paribas, and Societe Generale throughout the week, Matt.
All right, hawkish bets on rates are moving higher, and ECB Council member Klaus Knott says he expects a hike as early as October. Now, he's no dove, so that's not a huge surprise. But last week, the ECB made a hawkish pivot with President Christine Lagarde no longer excluding a rate hike this year. Let's get more with Christine Aquino, who helps lead our markets coverage. And the story, certainly in Europe, is all about rates, Christine.
Absolutely, Matt. We're seeing a major repricing in these money markets, particularly for the ECB. I think especially because the ECB prior to last week was seen as the furthest away from this prospect of rate hikes. You might remember that before last week, we saw commentary from ECB Governing Council members, even in January and in the early days of February, saying that, they're really not looking at rate hikes until 2023. That all went out the window last week. We saw an indication from them that they're not going to be ruling out a rate hike this year. Now, the big question is, of course, when they're going to fire that starting gun on rate hikes and how fast they're going to go, both on the tightening cycle and also in terms of their asset purchases.
Yeah, and so good morning to you, Christine. If this is all about nervousness about just how quickly we get then this move from the ECB, interesting to ask what that does to the periphery of Europe, because that's where we seem to be seeing the market reaction quite extreme this morning. The BTPs, the Italian debt products, but also over in Greece. Are you worried more about that on the sovereign side, or is it the spread widening we're also seeing in European corporate debt, in the high yield and also investment grade?
Well, and I think these are things that we should all keep an eye on, both on the credit side of things and the periphery side of things. These, of course, are the more risky parts of the European debt market and potentially more vulnerable to a faster pace of ECB tightening if we do, in fact, get there. And so very much keeping a focus on those Italy spreads, those Greek spreads, and those corporate bond spreads. These will be kind of at the front lines of any violent reaction, especially if we get faster than expected ECB tightening cycle.
All right, Bloomberg's Christine Aquino, thank you so much. Really dramatic movement we are seeing in rates markets across the world. Now let's get over to politics and over to Washington. President Biden and France's Emmanuel Macron talked by phone about responding to Russia's military buildup on the Ukrainian border. Of course, later this week, Macron is due to visit both Moscow and Kiev. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now. Anne-Marie, as Biden heads into a meeting with Scholz and Macron heads into meetings in Ukraine and in Russia, are the U.S. and France on the same page?
Well, they've spoken a lot over the past few weeks. I think it's been about 3 times since last Wednesday. And really, Kay, there's going to be a flurry of diplomacy given the fact that there are reports that Russia at this moment has amassed 70% of the troops it would need for a full invasion of Ukraine. So actually, it's going to be today that President Emmanuel Macron will sit down with President Vladimir Putin. He's going to work on some de-escalation and try to get Putin to at least agree to continue on this diplomatic path forward. Macron's inner circle like to really paint him as a foreign diplomat that can be a linchpin in the Western allies' push when it comes to Moscow. And this really, for Emmanuel Macron, is 5 years in the making. In 2017, when he won re-election, he said that he wants to recalibrate and have reset of talks with Russia. It hasn't always worked in his favor. So this is going to be a very important meeting for him and his government. And then following that, he's going to be heading over to Kiev.
Anne-Marie, the Germans have asked to raise sanctions on Russia in every way except for the one way that matters, right, on energy. Biden wants to push Olaf Scholz, or wanted to push him on that in a meeting. What do we know?
So obviously, when Olaf Scholz, the Chancellor of Germany, sits down with President Biden in the Oval Office, the questions I imagine will quickly, and the discussion will quickly turn to what are we going to do about Nord Stream 2? So Olaf Scholz was asked about this in the Washington Post interview last night, and he said all options are on the table. But you got a very much more direct response over the weekend from National Security Advisor Jake Sullivan, who said one way or another, if there is a further Russian invasion on Ukraine, the second half, Nord Stream 2, the last leg it needs to be operational, will not go through. That would be the end of Nord Stream 2. So the Americans at this moment are very aggressive on how they're going to use Nord Stream 2 as leverage when it comes to sanctions against Russia.
Okay, thank you very much to Bloomberg's Anne-Marie Horden, tracking the visit of Chancellor Olaf Scholz then to Washington for us, well, to the United States. Now, after a brutal fall in its share price, Peloton is evaluating potential takeover bids, but the fitness company could find a challenging climate if it opts for a deal with a big technology firm. Let's get more details from Bloomberg's Danny Berger. Danny, what do we know here?
Well, I should just say off the bat, Anna, that the market likes this one, or at least thinks it's going to go through. We're looking at pre-market Peloton up more than 22%. But if anything, this is just logical. Excluding this pre-market move, a price tag on a Peloton takeover would just be so much cheaper than it would, say, a year ago when Peloton was valued around $50 billion. Today, it's just around $8 billion. So Bloomberg reporting suggests that Peloton has hired advisors. They are looking at potential offers. Other reports suggest that it could be Nike, it could be Amazon. Dan Ives over at Wedbush saying that maybe Apple will get involved, just sort of defend themselves if other people move into fitness. But the issue here is that the regulatory environment in Washington, especially around big tech, has gotten much more icy. So our very own Bloomberg Intelligence suggesting that a Peloton deal, this company might just be too small, not worth the headache for one of these big tech firms and just serve as a distraction.
Although they're trading at only 2 times sales, what do we know about their earnings coming out on Tuesday?
Well, they are going to be crucial if Peloton wants to bat down any of these suggestions that they're going to be bought. We had a preliminary earnings from them last month where sales miss, subscribers miss, and in that statement, the CEO really concentrating on cost, saying we're taking significant corrective action to improve our profitability outlook and optimize our costs across the company. They said that tomorrow, this earnings report would be when they detail those costs. But again, Bloomberg Intelligence says that they need to be more aggressive. It can't just be cost. They need to look at extreme action, maybe even M&A in their own right to really lift things up at this point, Kailey.
All right, well, we will wait and see what those earnings results look like tomorrow and continue to monitor the shares throughout the day today. Thank you so much to Bloomberg's Danny Berger. Now, while Peloton is moving to the upside in a big way in pre-market trading, there are a number of other stocks moving as well that we should note. Matt was talking earlier about the fact that we're seeing Bitcoin gaining today, and that's reading through to pretty much all crypto-related equities, including Marathon Digital, which is up about 5% before the bell. Another stock moving to the upside is On Semiconductor. This is due to report earnings before the bell here in the U.S. today. About 8 a.m. Eastern time is when we are expecting those, and it seems that shares are getting bid up going into that print. That stock up 4% before the bell. Finally, one other stock to note is Snowflake. That is the software company. It was raised to overweight at Morgan Stanley. The price target on that stock, $390. That implies about 41% upside to Friday's close, and as a result, that stock is up about 3.8% before the bell, trading right around $286, Anna.
Kailey, when we come back, we'll talk to Derek Halpenny, MUFG's head of research, global markets, EMEA and international securities. What does spread widening across Europe mean to him? How worried, how concerned should we be about that? And on the geopolitics front, Russia and Ukraine, Leslie Vinjamuri, Chatham House head of US and the Americas program, joins us. Can Western allies really get on the same page on all of this? We'll have analysis from Leslie coming up shortly. Plus, later today, we'll speak with the Nobel laureate and NYU economics and business professor Michael Spence. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. Now, we have seen some real volatility in the rates markets. It really dwarfs the kind of volatility that we've seen in equities. If you look at some of the moves, especially in the peripheral spreads, they're just shooting higher. It would equate to 3, 4, 5, maybe even 10 or 15% drops in equity indexes, but we're not seeing that in stocks. Justina Lee, Bloomberg Markets reporter, joins us now to talk about why that is. Justina, everyone in Europe is breathless about the moves in rates, but you're not seeing really big moves in stocks. Why is that?
Yeah, that's really interesting because, of course, we've seen a bit of a correction, but I think based on kind of the chart that you just showed, it seems like it's nowhere, kind of close to what potentially we could see later. I think one reason is because generally investors are still pretty happy with the state of the economy right now. I mean, we can see that from last week's U.S. jobs numbers. On one hand, yes, people got more worried about rate hikes, but on the other, it does show that the economic recovery is still trudging along pretty nicely.
Yeah, it's interesting on that subject. I'm just looking at a piece from our colleagues talking about Bank of America's view, saying equities are unlikely to lose their attractiveness relative to bonds anytime soon, particularly in Europe. That's the view over at Bank of America. But in terms of the higher rates environment, Justina, it isn't just a U.S. story. It's not just a European story. It's global, of course, with the exception of China. If you look on a map at parts of the world where we're seeing holds and hikes, obviously China stands out as a place where we're still seeing looser monetary policy. How do we play that divergence?
Yeah, that's interesting because even now we're hearing kind of noises about monetary tightening, even in Europe. I think in China, they're kind of on a very different path now. And of course, given the sharp discount that we're seeing on Chinese stocks right now, it would be interesting to see whether investors are moving back to that region, especially if they get a little bit less worried about the regulatory picture over there.
Justina, obviously we're all focused on the macro picture, on the prospects of policy tightening across the world. We're still also in earnings season. Does it matter at all?
I think in a way it kind of matters even more because, like I said, one kind of solid backing for the stock market right now is that if, investors are seeing earnings numbers that they like, it might kind of support the market in the sense that, sure, rates are going up, but at least kind of the economic picture is still looking well. And I think for now, it does seem like that support is still there.
So what kind of earnings are we expecting for this quarter, and what kind of earnings are we expecting throughout the year? I mean, is inflation going to be a big damper on margins?
Yeah, I think it kind of depends on what companies we're talking about. And we're really seeing kind of from the moves in the past few weeks that markets have become a lot more sensitive to disappointments. I mean, that's quite apparent, if you contrast the Facebook results with the Amazon results. It's not like, Facebook is not growing anymore, but, with those multiples already so high, people are very sensitive to any kind of letdowns.
I was talking to our colleague from Bloomberg Intelligence earlier on around the earnings season, and one of the phenomena he was pointing out was the buildup in inventories we're seeing. And it might be, you can compare it back to 2019 and the levels we're seeing there. Part of it might be this sort of bullwhip effect. So companies go through phases, don't they, of ordering a lot of stock and then not much because they're really uncertain about demand levels right now through the pandemic. But also he was suggesting, we're moving from maybe just in time to just in case, and that means companies build up these inventories, which is going to weigh on balance sheets.
Yeah, that's interesting because the lesson I think a lot of companies have learned kind of in the past few years that sometimes supply chains are not kind of as reliable as you think. And of course, we've seen very strong consumer demand even during the pandemic. And now it seems like some of that has kind of kept quite solid.
Okay, Justina, thank you very much. Bloomberg's Justina Lee joining us here on set in London with thoughts on market moves. You can get up-to-date analysis on all of the market's latest movements. MLIV Go is the function to use on your terminal to stay across the Market Live Teams blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's get the first word news. And a state of emergency has been declared in Canada's capital over a protest against vaccine mandates and COVID restrictions. Hundreds of trucks have been parked in downtown Ottawa near the Canadian Parliament. The city's mayor says that increasingly rowdy demonstrations pose a threat to the safety and security of residents. President Biden's top advisors are repackaging his economic message to the American public. That comes at a time when his approval ratings are sinking and his legislative agenda stalls in Congress. In the last week, the president has put more emphasis on growth in wages, union jobs, and domestic manufacturing. He's giving less weight to areas that are sore points with voters, such as inflation and the partisan strife over COVID. In the UK, a no-confidence vote on Prime Minister Boris Johnson could come as soon as this week. A minimum of 54 Conservative members of Parliament would have to support a vote, and the Sunday Times reports that some predict the total is approaching that. One Conservative lawmaker tells The Observer, quote, "It is going to end in him going." Over the weekend, Johnson filled 2 key positions after senior aides quit. And the CEO of Spotify has apologized to staff for the controversy over Joe Rogan's podcast. Rogan is under fire for making racial slurs and spreading COVID misinformation. But Daniel Ek says he still doesn't agree with calls to drop Rogan from the streaming service. He says Spotify will spend $100 million on content from historically marginalized groups. So, Anna, that drama continues at Spotify. My question is, how much pressure will continually be put on Spotify from other artists, and do they have to change their tune when it comes to Joe Rogan?
Yeah, we'll see if the current line of argument holds. What is clear is the big leap it is from a management team to go from streaming music to putting out podcasts where you're, on the music side of things, you can categorize the lyrics based on whether there's any particular language in there that people might find offensive. But that's a relatively simple issue compared to what they're having to deal with now. Incredible story to watch. When we come back, we'll get back to the markets conversations. Eric Halpenny, MUFG, Head of Research, Global Markets, EMEA, and International Securities, joins us. We'll ask him about this global higher interest rate environment we seem to be talking a lot about this morning. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York, and here's what you need to know. The global bond rout is spreading. The strong US jobs report stoked expectations that central banks around the world will be aggressive when it comes to raising interest rates. Traders see a 40% chance the Federal Reserve will kick off rate hikes with the sharpest increase in 2 decades in March. President Biden and France's Emmanuel Macron talked by phone after responding to Russia's military buildup on the Ukrainian border. This week, Macron is due to visit both Moscow and Kiev. Meanwhile, Germany's Chancellor Olaf Scholz will have his first meeting with President Biden since taking office. Now, shares of Peloton are soaring today. The company is said to be exploring takeover options. There are reports that both Amazon and Nike are considering making offers. Peloton stock has fallen more than 20% from the high a year ago. It's a little bit higher in pre-market then. Let's take a look, that is a look at what you need to know. Matt, what are you focused on then as we head towards the start of another trading week?
I'm focused on what kind of moves we're seeing in S&P futures here, Anna, because they don't seem severe compared to the jumps that you've seen in peripheral rates, the jumps that you've seen in the U.S. 10-year yield, the jumps that you've seen in NYMEX crude, although it's down right now. Look, S&P futures bouncing back and forth a little this morning, mostly on the downside, but only 0.2% after finishing last week with a gain on Friday, 0.5%. Meanwhile, yields shot up. We're over 190 on the 10-year. We're well over $90 on NYMEX crude. It's coming off a little bit, but still holding at that level. And Bitcoin is rising more than 2% to 42,533. So it doesn't look as disastrous in the U.S. pre-market as it does when you look at peripheral yields in Europe. Kailey, what are you looking at in terms of pre-market movers?
Well, Matt, I'm watching the Peloton story that Anna mentioned, of course, reportedly exploring some takeover interest because, honestly, it's a much more attractive target now than it was, say, when it hit its record high, which was some 80% ago. It is down that much since the record it reached, though it is recovering some of that this morning. It's up about 24% in pre-market trading. A lot of optimism potentially about that takeover. Another stock moving to the upside goes along with Bitcoin moving higher, as you mentioned, Matt, and that is MicroStrategy. Basically, all crypto proxy equities are moving higher today. It is up 4.7%. A few stocks moving to the downside to note, though, one being Alibaba. It filed to register 1 billion previously unregistered shares when it comes to those ADRs here in the U.S. That to Citigroup is a sign that maybe SoftBank is getting ready to sell some of its stake. We saw Alibaba shares down in Hong Kong as a result, and those ADRs are down in pre-market trading here in the U.S. by about 3.7%. And one other stock moving to the downside again is Toll Brothers. This, of course, is a home builder. It's already down 25% year to date as we see expectations for tighter Fed policy, which could ultimately lead to higher mortgage rates and slow down the housing market as a result. It is adding to those losses this morning, Anna, down about 4.6%.
Yeah, and the changing role of the Fed in the mortgage market as well, we're thinking about there. Kailey, let's focus in on what we've seen here in Europe. And to Matt's point about how we're seeing quite a lot of volatility in spreads in the periphery of Europe, in the bond markets, and that's not necessarily leading to everybody throwing away the TINA model right now. So there does seem to be some appetite for stocks, even quite muted. Right now, we're fairly flat, I suppose, across European equity markets. Some areas getting support from the mining sector. So areas like London, where you do see a heavy presence of mining stocks, and those higher commodity prices have been helping and continue to do so this morning. This is the spread widening we're talking about, though. This is Italian BTPs over bunds, and we have seen this spread widening up to 162 here. It's not just Italy, it's Greece as well, and a lot of people talking about how traders are kind of reaching for that Eurozone debt playbook here when it comes to European peripheral spreads. Reckitt Benckiser, interesting to see what kind of pushback we get then from the ECB, if there is any, and therefore maybe these moves have been overdone. Reckitt Benckiser, a consumer goods company here in the UK, that stock up 0.4%. There was a great Bloomberg scoop at the end of Friday talking about how they might be about to sell their infant nutrition business. And Faurecia makes car parts, car spares and the like. And they've done a deal with one of their German rivals. They bought that business, combined the two, and they've renamed themselves today. And the new targets have gone down well, with investors up by 2% and a bit. Kailey.
All right, Anna, well, I'm continuing to watch that bond story that you mentioned. Obviously, we're seeing spreads widen, a dramatic sell-off in the periphery. Just to put it in context, the 10-year BTP yield right now is 1.85%. That is some 55 basis points higher than we were Monday a week ago. So let's get more on these dramatic moves we are seeing, the repricing of expectations when it comes to the ECB. Joining us now is Derek Halpenny, head of research for global markets, EMEA, and international securities at MUFG. Derek, are these moves overdone at this point, or do we still have further to go?
Well, I think you've got to take this in the context of what was a very significant pivot from the ECB on Thursday. And the scale of that move, the shift in rhetoric, I think has prompted this pretty aggressive shift in positioning. You know, it's logical and it's understandable given the timing of that support in terms of ECB buying through PEP and APP could come to an end sooner than expected. And I think that's a reflection of the price action we're getting. I wouldn't necessarily say it's problematic at this point. Of course, the scale of the move is very, very significant. And of course, it will be something the ECB will be looking quite closely at. But it makes sense. And I don't think the ECB would be hugely surprised by the way in which the markets have reacted to what was said by Christine Lagarde on Thursday.
Good morning to you, Derek. We see, yes, that the spreads is what we're talking about here. We also see equity markets reacting a little bit to this. FTSE MIB, for example, down by 1.6%, and there could be some read across, although it's a little more complicated, some oil stocks to the downside as well. Do you think the ECB would want to push back against the speed of the move here, or the way that these concerns are being expressed with the peripheral bond spreads? You know, the ECB very alert to not wanting to widen those spreads unnecessarily, perhaps.
It's a tough task. Like Lagarde speaks this afternoon, so let's hear what she says today. But you know, there's no getting away from the fact that the ECB has pivoted. Now they can balance that up to some degree, and of course, I think what's priced into the rates market from by the end of this year, I think is excessive. But I think, you know, rates in the UK are excessive. I think rates in the US are probably excessive. But we're in a current market mindset of investors, I think, essentially not believing the communications about contained moves, because essentially, if you look back over the last 3 to 4 months, central banks have been playing catch up to the reality of what's happened with inflation. And therefore, whenever there's a pivot, the markets are going to overreact because they're pricing in the prospect of another pivot.
So does the market think you were late, therefore we don't believe you now when you say you'll be slow?
Yes, essentially the risks are that the ECB will have to pivot again if inflation remains higher than expected. So of course, everything about trading for investors is timing. So I think at some point this year, there will be a point when that can readjust. But we have another couple of months of inflation that's probably going to be more to the upside than to the downside. And we need to get through that period. We need to get through the first rate hike from the Fed, a couple of other kind of moments to get through before we start to see inflation falling back again. And then perhaps some logic can come into the markets about whether or not we need to have that extent of aggressive tightening going forward.
But Derek, we have a great picture of the balance sheets of the big four central banks, and they're holding more than $25 trillion worth of debt on their balance sheets. If they start to unload this, and Andrew Sheets at Morgan Stanley thinks that they'll reduce by about $2 trillion between May 22 and May 23, what kind of effect does that have on financial markets?
Well, the extent of liquidity injections because of the pandemic was unprecedented. And most importantly, the broad-based actions from G10 when it came to balance sheet policy, that was very different. Global financial crisis was much more G4. So, the reversal of liquidity is going to be significant. And I think that's where you're getting some of the reactions in the rates markets. Like our view in terms of maybe later in the year, investors start to question the extent of what's priced into the market. I think that will follow evidence of the very difficult, challenging financial market conditions and much higher volatility that's going to come. And that in itself has important implications for the real economy. Let's face it, the financial markets tied to the real economy is very, very significant.
Yeah,
more significant than before.
And that's absolutely what I'm getting at here, Derek. I mean, a lot of companies have positioned themselves for lower rates for a lot longer, right? And there are going to be companies that can no longer borrow at lower rates. There are going to be companies that can no longer borrow at all. How significant is that effect going to be on the real economy?
Well, you're talking about companies that can no longer borrow. Of course, that's hugely problematic. I'm not sure we're going to get to that state this year. Again, our assumptions are that at some point, summertime, we're going to have a readjustment in terms of the extent of tightening that's priced. And of course, part of that on the rate side is because of what will be unfolding on the balance sheet side. For certain corporates, it's going to become a lot more difficult. But we also shouldn't forget the corporate earnings results that have come out to date. I think one of the surprises has been the way companies have been able to manage the inflation spike so far and the way they've been able to manage through the pandemic. So the corporate sector and the balance sheets of the corporate sector are pretty healthy in many of the major economies. And that will help, I think, diminish the immediate negative impacts of what's happening in the rates market.
Yeah, I was talking to one colleague from State Street earlier, Derek, who was making the point that those balance sheets are healthy and we could still have a capex cycle, even as central banks pull back, more capex to invest around. So certainly something to watch. Yeah. Derek, thank you very much for joining us. Derek Halpenny, Head of Research for Global Markets, EMEA and International Securities at MUFG. Thanks to Derek for spending time with us. Next up on the programme, Leslie Vinjamuri, Chatham House, Head of US and the Americas programme, will be with us. We'll talk geopolitics, tensions between Russia and Ukraine. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. We're looking live at the Principal Room. Coming up later today, former U.S. Secretary of the Treasury, Bob Kimmitt. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
Our current situation is very turbulent, but I believe that with support of our international partners, we can be able to move further. First, I want to thank all our international partners from United States to British, France, that are able to build up a strong support from Ukraine. First, it's a IMF program, then it's a MFA program from European Union, and also it was mentioned Canada, Germany, France, and other partners that are doing their best to support Ukraine.
That was Ukraine Finance Minister Serhiy Marchenko speaking with me a little earlier on today. Joining us now for more on Ukraine tensions is Leslie Vinjamuri, Chatham House head of US and the Americas program. Leslie, good morning to you. Great to have you with us. And we keep saying that Russia has said repeatedly that it has no plans to invade Ukraine. Also, when I spoke to the Ukrainian finance minister, he said to me, Leslie, that it's not necessarily. He was talking about financial support that they might be seeking from Western allies. He said it's not so much the amount of money that might be available, but the message that it would give. I suppose a country like Ukraine, whose economy might have been suffering at the hands of deteriorating expectations based on this tension, they will be grateful for any kind of signal that would be provided by Western support.
Absolutely. I think you're exactly right. The need right now for Western unity couldn't be greater. We see the German Chancellor traveling to Washington. He's in Washington now to meet with President Biden today. That is a very important set of meetings because, of course, Germany has been seen to be not strong and united as much as the United States and others would like it to be. And Russia sniffs this out. China sees this. We saw the statement just a few days ago from Russia and China, which are clearly showing tremendous unity. So I think for Ukraine and for the general stability of the situation, having that on any number of questions, but just generally is incredibly important to the ability of the U.S. and its partners to really deter the potential for Russia's future aggression.
Well, on the subject of Ukraine, Leslie, we are just getting some headlines out of the Ukrainian foreign minister who says he will continue to ask Germany to approve weapons supply and that Germany's current stance on weapons supply to Ukraine is, quote, not fair. How difficult is this challenge for Olaf Scholz to navigate as a new leader of Germany post-Merkel era?
Well, this is clearly very difficult for Germany in general. It's particularly difficult for this chancellor who's facing a lot of division on this question within his own coalition, within his own party. Not an easy thing, of course, for Germany to approve export of lethal aid in any case, but going so far as to block other partners from sending those weapons to Ukraine, I think, is a real sticking point and a source of potential division within the alliance, and also something that symbolically as well as in real terms, of course, is very difficult for Ukraine. So I think that this is one of the key issues for Germany. The other one we know, of course, is its position with respect to whether Nord Stream 2 would be considered in that sanctions package, and the EU is working very carefully, as is the US, to pre-approve or pre-agree a set of sanctions that could be approved were there to be an invasion or violation of Ukraine's sovereign borders.
If there were an invasion of Ukraine's sovereign borders, would European countries continue to pay Moscow for gas?
Well, this is one of the key questions here, right? And
would they have any other choice, Leslie?
Well, I think the move right now is to try and develop alternatives, right? Alternative sources of energy. It's very difficult to get those to the level that they're needed. This is clearly an immediate problem, but it's also a medium and long-term problem for the energy transition in Germany. So this and the question of sanctions on Nord Stream 2 is this is why it's so difficult. And I think we're going to see that conversation. We probably won't see it visibly. We'll see it discussed. It will be discussed in Washington today. And we saw the interview that was published by the Washington Post with the German Chancellor, where he talks about the need for strategic ambiguity. In other words, he's not going to be pinned down on this question of sanctions for Nord Stream 2.
And you talked there about diversification of energy supplies, Leslie, which sounds like much more of a longer-term initiative. In the very short term, we understand the US has been talking to all kinds of different players around the world to try and assess if there's any way of supplying further energy to Europe should it be needed. But there aren't alternatives, are there? And so Germany will continue to plough this course of strategic ambiguity, as you describe.
Absolutely. It's a very difficult position to be in. It's difficult for the West, and it's a political and daily reality, potentially, for Europeans in the face of a difficult winter. And a highly dependent energy situation. It shows,
Leslie,
right, as
so
we've
much.
seen.
Thank you. No, finish your point.
It just shows that we're now in a situation, whether it's with China or with Russia, where there are deep dependencies globally amongst partners that simply don't have the same security interests, don't share the same values, and where tensions right now are extremely high, and the situation is very dangerous.
Leslie, thank you very much. Leslie Vinjamuri, Chatham House head of US and the Americas program. Coming up later today, former US ambassador to Germany, John Emerson. That is at 10:30 a.m. in New York, 3:30 p.m. London time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Tom Keene is the co-anchor of Bloomberg Surveillance, and he joins us now with a look at what he's watching to kick off this week. Tom?
Less data coming off the jobs report. You see less data, Matt, than you're ever going to see. But I think there's really been a sea change here. It's identified over the weekend, and a lot of the research we'll go through today on Bloomberg Surveillance. But that is, the negative yields evaporate. And as you well know, mostly in Germany, where you've lived negative yields. And, you know, the real question for me, Matt, is how will this change commercial banking in Europe? It's something David Folkerts-Landau, Deutsche Bank, has talked about for years. Let's go to the chart. It's a chart a lot of people have shown here recently. Nothing original here other than the plunging amount of negative yielding debt really getting back through 2017 and back to 2014 levels.
Tom, we're also going to hear from Christine Lagarde later this morning. What does she need to say and or not say to this market?
I think you're dead on. It's a type 2 construct. It's what she doesn't say. It's going to be fascinating to see, as John Farrow, who's better at this than I am, mentioned, what a shift we saw from even the transitory headlines of the other day to the press conference. And it's going to be interesting to see how she reaffirms that or if she just avoids it.
Yeah, absolutely. So peripheral spreads very much in focus here, Tom, in Europe, but also US inflation will be in focus later on this week. And we have that report due Thursday, I think.
Yeah, it's an important statistic, if not the statistic of the week as we continue earnings in America. What I would suggest underpinning this, Anna, in America is everyone's attention to rent and housing. J.P. Morgan did a fabulous effort Friday evening on housing. Michael Ferroli over there just did a great tear apart of housing, and he looks for housing pressures and price pressures to continue.
All right, definitely going to be paying close attention to that. Tom Keene, co-anchor of Bloomberg Surveillance, thanks very much for joining us. Look forward to the program. Let's get to what else we're watching, and I'm paying attention to the Biden meets Schultz story, even as we talk about strategic ambiguity, which is, I guess, a phrase that means Biden or Schultz doesn't have to tell Biden what he already knows, which is that they're dependent on Russian gas, and they don't really have any other choice. I mean, even if we ship all of our LNG to them, it's going to take a while to get there, and that's not going to be enough for Germany's needs. I'm also, by the way, watching this Peloton story, Kailey. The idea that this company was once worth $50 billion is pretty shocking now that it's trading for $8 billion. And that's a serious discount if any suitors decide they want to pick up the exercise bike company.
Yeah, down 80% from a record high, though it's up 24% in pre-market trading right now, so it's definitely gaining some of that back. I am watching what we were just discussing with Tom, ECB President Christine Lagarde speaking later on this morning, 10:45 a.m. Eastern, 3:45 GMT. She's going to be giving the introductory statement at a hearing of European Parliament's Economic and Monetary Affairs Council committee. As we were saying, is kind of about what she doesn't say, given she said a lot on Thursday that changed the market's mind about the trajectory of monetary policy in the euro area. So does she try to walk that back somehow today, Anna? It'll be interesting to see, especially for this bond market.
We've heard from the Dutch ECB leader, of course, Klaus Knot, who talked about the fourth quarter of this year being possible for rate hikes. The market seems to think September could be. So third quarter, fourth quarter, we'll see what she has to say, if anything, about timing. But linked to your story then very much, Kailey, looking at these bond spreads, peripheral bond spreads, 163 for Italy BTPs, Greek debt, also the spread widening there, 225. We're told by colleagues that's in a low liquidity environment. But will Christine Lagarde decide to push back against any of that spread widening? She has perhaps confused the market in the past with her views on the spread, so we'll certainly be paying attention to that. More Bloomberg Surveillance is ahead.